Welcome to the Deep Dive. We take important sources, cut through the noise, and bring you the key insights.
And today we're digging into the first quarter 2025 earnings call from Niu Technologies.
Yep. Our goal here is to unpack everything important from that call, the numbers, the operations, what management's thinking.
Exactly. Giving you the crucial takeaways without you needing to wade through the whole thing yourself.
All right, let's jump right in. What was the quick snapshot for Q1 2025? The headline numbers.
Okay, so headline-wise, the big story is volume. Total sales volume hit 203,000 units.
203,000. How does that compare?
Well, that's a pretty significant 57.4% increase year over year. Really strong growth there.
And revenue.
That volume pushed total revenue up to RMB 682 million. That's a 35% increase compared to Q1 last year. Solid top-line growth.
Okay, strong volume, solid revenue growth. What about margins?
Gross margin actually saw a nice rebound from the previous quarter. It came in at 17.3%.
Better than Q4 then.
Oh yeah, up 4.9 percentage points from Q4 2024. So some improvement there, but, and this is the other side of the coin.
There's always a but.
Right. Despite the growth and the margin improvement quarter over quarter, the company did report a net loss for Q1.
Okay, so initial read. Growth is definitely there. Margins are maybe heading the right way, but still in the red for the quarter.
That sums it up pretty well. It's that kind of mixed picture initially. But the feeling from management on the call was very much focused on that growth momentum.
Building on that 57% volume jump.
Exactly. And really outlining their plan, their expectations for profitability to improve later in the year. They sort of framed this Q1 loss as, part of the process.
Got it. So where did most of that growth actually come from? I imagine China was a big part of it.
Oh, absolutely. China was definitely the main engine. Sales volume there was 183,000 units.
Whoa, 183,000 out of 203,000 total. What was the growth rate there?
In China, it was a massive 66% increase compared to Q1 last year.
66% year over year in China. That's huge. What exactly were they doing to achieve that kind of number?
Well, it looks like a combination of things. A core part was their product strategy, really focusing on the key NIU and F-series lines.
Any new launches driving that?
Yep, they highlighted a couple. The NX Pro was one that's positioned a bit higher end, targeting younger riders, priced just under RMB 10,000. They mentioned strong pre-orders, like 2,000 units, and good launch day sales.
Okay.
And then at the other end, they launched an upgraded entry-level model, the NL. That one's around RMB 4,800. It got practical upgrades, more storage, bigger footboard.
Things people actually use day to day.
Right. But also some smart tech, like a TFT display, those clear modern screens and integrated navigation.
Interesting. So pushing more tech features even into the entry-level stuff.
Seems like it. And they also filled out their F-series lineup, models like the FX Pro, FX Sports.
Yeah. They
talked about bolder designs, bigger batteries, those TFT displays again.
And performance?
Yeah, significant boost there. They quoted figures like 45% faster top speed, 72% more peak power compared to older versions, plus safety tech dual channel ABS.
Anti-lock brakes, yeah. Important.
Definitely. And something they called a magic wheel for easier maneuvering. Those F-series models actually just started selling in Q2. They launched in May.
So it sounds like a big theme is taking tech, especially safety tech, and spreading it across more of the range, not just the absolute top models.
That's a really good way to put it. They mentioned leveraging tech from their electric motorcycles for their e-bike line too. The NXT model, for example, now gets dual ABS and a boost launch.
And they seem to be targeting specific groups too.
Yes, definitely. They specifically called out two new M-series models, the MT and MMT, described them as compact, colorful, aimed right at female users and Gen Z.
Did that work?
Apparently so. The M-series overall was a big contributor, made up 32% of their total sales volume in Q1. Significant.
Wow. Okay, so product innovation, specific targeting. What else helped in China? Margins improved there too, right?
Yeah, they mentioned platform standardization and cost reduction efforts helped the China gross margin. And they didn't just talk product features, but also safety tech advancements.
Like what?
A partnership with Gill Maps. It's a data-driven system providing safety warnings, things like blind spot alerts, vehicles approaching, even AI-guided help for traffic lights.
Yeah, for traffic lights.
Yeah, they said it's already live on the NXT model, with more features planned. It connects their smart tech directly to rider safety.
Okay, product, tech, safety. How did they get these things in front of customers? Distribution, marketing?
Both were key. Channel expansion was big. They're pushing into smaller cities, opening 384 new stores just in Q1.
384 stores in one quarter.
Yep. And they said half of those were in Tier 3 and 4 cities. places they see as underrepresented.
And online. That's usually big in China.
Huge for them. They talked about a multi-tier online strategy, running 10,000 live broadcasts in Q1 alone.
10,000?
Yeah, generating something like 430 million views, a 6x increase year over year. And the result? Online sales accounted for around 100,000 units.
Wait, 100,000 out of 183,000 in China. That's over half.
It's about 60% of their total Q1 volume, yeah. Massive contribution from online.
Incredible. Any regulatory things on the horizon in China?
Yes, there's a new national electric bicycle standard coming into effect in September. Management seemed prepared, though. They said they have a new product line ready specifically to meet those new rules.
Okay, that paints a really strong picture for China. Let's switch over to the overseas markets then. How did things look there?
Overseas was a different story in some ways. Total Q1 volume was 20,000 units.
Just 20,000, so the growth wasn't as dramatic?
The overall growth was modest, 6.4% year over year. But, and this is key, within that number, the electric two-wheeler segment, so mopeds and motorcycles, that part saw significant growth.
How significant?
They said volume there tripled, a 3x increase compared to Q1 last year, just for that category.
Okay, 3x growth within the overseas number. That's interesting. What's fueling that particular jump?
A big factor seems to be their direct distribution push. They've been building out their own operations in key European markets, Germany, Italy, France.
Taking more control instead of just using third-party distributors?
Exactly. And those direct operations accounted for over half, more than 50% of their total overseas sales volume in Q1.
So that strategy seems to be working.
And they're expanding the dealer network within those direct regions quickly. Went from 120 dealers to 180 just in Q1. They're projecting 250 by the middle of this year, which they said is actually ahead of schedule.
Right. And what products are driving that 3x growth in the two-wheeler segment overseas?
They've launched a whole new lineup there, everything from 50cc equivalent mopeds up to 125cc equivalent motorcycles, even some off-road stuff. Price points ranging from about €2,000 up to €4,600.
Covering a wider range of needs then?
Seems to be the plan. A first batch shipped in Q1, so they should be hitting showrooms now, ready for the Q2 peak season.
And what's the outlook for that specific segment, the electric mopeds and motorcycles overseas?
They sounded very bullish on that. Management used the term exponential sales growth. Specifically, they guided for a 3 to 5 times increase in volume for the full year 2025.
3 to 5 times growth for the full year.
That's what they said. They clearly see this category, especially sold through their higher margin direct channels, as a major profit driver for the international business going forward.
Okay, that sounds like the positive side of the overseas story. What about the other part, micromobility, kick scooters, e-bikes?
Yeah, that's where they face more headwinds in Q1. Volume growth there was almost flat year over year, and the profitability turnaround they'd hoped for got delayed.
Why the delay? What were the issues?
They pointed to two main things. The U.S. tariff situation, which is still ongoing, and needing to clear out old inventory in Europe.
Right. The U.S. tariffs, that's the extra 25% tax on goods from China. How's that playing out?
Yeah, that 25% tariff hit them hard starting last June. So because of that cost and uncertainty, they actually held back on selling their existing U.S. inventory in Q1.
Intentionally slowed down sales.
Seems so. They also mentioned raising prices online in Q1, and they're planning offline price hikes later in Q2 or maybe early Q3 to try and offset those tariffs.
And the European inventory, what was that about?
Basically, they spent Q1 focused on selling off older micromobility stock in Europe. That obviously hurt their gross margins and profitability for that segment during the quarter.
Makes sense. Clearing out old stuff usually means lower prices.
Right. They do expect some lingering impact into Q2, but they think it'll be much better by the second half of the year once that older inventory is gone.
So what are the strategies to deal with these micromobility challenges, especially the tariffs?
Well, besides the price increases, the big strategic move is shifting manufacturing. They're moving some production for the U.S. market to Southeast Asia.
To avoid the China tariffs.
Exactly. They said the first shipments from Southeast Asia actually started dispatching late in Q1 under a lower tariff rate. They mentioned under 10%. But those sales weren't reflected in the Q1 numbers yet.
Okay, so the plan is price hikes plus shifting production should help micromobility turn around, but probably not until the second half of the year.
That seems to be the expectation. They guided for moderate growth overall in overseas micromobility, but importantly, significant profitability improvement, specifically in H2 2025, as these strategies take effect and the inventory issue clears up.
Okay, we've got a good handle on the operations in China and overseas. Let's dive a bit deeper into the financials they presented.
Sure. So breaking down the revenue numbers further, China brought in RMB 608 million. That was 89% of the total. Within that, China's scooter revenue was up 39%, mostly from that volume surge we talked about.
And overseas?
Overseas was RMB 74 million, the other 11%. Scooter revenue there was up too, which they linked to more sales of those higher priced electric motorcycles and mopeds.
Right, and accessories, parts.
That segment did well too. Revenue from accessories, spare parts, services was up 20% year over year. Shows they're growing their aftermarket business in both markets.
Now, I remember you mentioned the gross margin rebounded quarter over quarter, but the average selling price, the ASP for scooters in China actually went down. How does that work?
Yeah, that's a good question. The China scooter ASP was just under RMB 3,000. Management's explanation was it was really about product mix within Q1. Meaning in prior quarters and even in Q1 last year, they had strong sales from some higher end models, maybe lead acid ones or flagships priced more in the RMB 3K to 7K range. But the specific new models that launched and sold really well this Q1 happened to be at slightly lower price points compared to what drove sales in Q1 last year.
Ah, okay. So it wasn't that prices dropped across the board, just that the mix of what sold this quarter was skewed a bit lower than the mix last Q1.
Exactly. It's about which specific bikes were popular right now.
Got it. And overseas ASP?
That actually nudged up a little bit from around RMB 25,777 to RMB 25,962. And that, again, was product mix, more of those pricier electric motorcycles and mopeds being sold.
Okay. And overall gross profit dollars were up, but the margin percentage was down slightly year over year.
That's right. Gross profit dollars increased to over RMB 118 million from RMB 96 million last year. But the overall company gross margin percentage was 17.3%. That's down 1.6 points from Q1 last year.
But up significantly from Q4, as you said.
Yes, up 4.9 points from Q4. They broke down the year-over-year change. The domestic margin improvements actually added 1.2 points to the overall margin. But the problems overseas, the tariffs, freight costs, writing down that old inventory that dragged the total margin down by 2.8 points.
So that overseas micromobility situation really pulled the overall number down quite a bit.
It definitely had a noticeable impact on the consolidated margin percentage for Q1.
How did operating expenses look? Any improvement there?
Yes, this was actually a positive point. Total operating expenses, or OPEX, were RMB 165 million, basically flat compared to last year in absolute terms.
Yeah.
But because revenue grew so much.
The ratio got better?
Exactly. The OPEX ratio expenses as percentage of revenue dropped significantly. It went from 32.7% last year down to 24.2% this Q1.
That's a big improvement in efficiency.
It is. Sales and marketing costs went up a bit in dollar terms, staff, ads, rent, but the ratio fell. R&D was similar, up slightly in cost, down as a percent of revenue. And G&A expenses actually decreased, partly thanks to some foreign exchange gains, so that ratio improved nicely too.
So costs didn't balloon even with the higher revenue. That helped the bottom line, even though it was still a loss.
Right. It shows better operating leverage. All this led to the GAAP net loss of RMB 39 million. That's a 5.7% loss margin, which is better than the RMB 55 million loss, or 10.9% margin they had in Q1 last year.
And adjusted losses.
Adjusted net loss was RMB 31 million, or a 4.6% margin. Again, an improvement year over year. GAAP, by the way, just refers to the standard accounting rules companies use for reporting.
Understood. What about the balance sheet? You mentioned cash was down.
Yeah, they ended Q1 with RMB 963 million in cash and equivalents, down from about RMB 1.1 billion at the end of 2024.
Any reason given for that drop?
Management explained Q1 is usually their lowest point for cash. It's partly seasonal Chinese New Year impacts timing, and it's when they typically clear out payments owed to suppliers from the previous year end. So they had an operating cash outflow of RMB 154 million in Q1.
In capital spending, CapEx.
CapEx increased slightly. They link that mainly to the investment in opening all those new stores in China.
Okay, that covers the Q1 results pretty thoroughly. What did management signal about the future? What's the guidance for Q2 and the rest of 2025?
The outlook they gave was definitely positive, aiming to build on that Q1 volume momentum. For Q2 specifically, they're guiding for total revenue between RMB 1.3 billion and 1.4 billion.
1.3 to 1.4 billion. That sounds like a big step up from Q1's 682 million.
It is. If they hit that range, it would represent 40% to 50% growth compared to Q2 last year. So a significant acceleration expected.
And the full year volume target, did that change?
No, they stuck with their previous guidance there. Yeah. Still expecting 30% to 50% year-on-year growth in total sales volume for the full year 2025.
Okay. What about the path back to profit? That seems critical after the Q1 loss. What's the outlook for margins and profitability?
Yeah, that was a key focus. They expect the annual gross margin for 2025 to recover from the 15.2% they saw last year. For Q2 specifically, the expectation is gross margin will stay somewhere near the Q1 level. They said it shouldn't drop below 15%.
And net profit?
This was a big one. They explicitly guided for a net profit turnaround in the second quarter.
Meaning they expect to be profitable in Q2, go from a loss to a profit.
That's the guidance, yes. Positive net profit expected for Q2. That would definitely be a significant shift.
How do they see selling prices going? You mentioned the Q1 China ASP dip.
They expect the domestic China ASP to recover somewhat in Q2, probably stabilizing in the RMB 3,200 to 3,500 range. Retail prices still focused in that RMB 3K to 7K sweet spot.
And overseas?
Overseas ASP is expected to stay high, maybe even climb, driven by that continued mix shift towards the more expensive electric motorcycles and mopeds.
What about cash after the outflow in Q1?
Management expects the cash position to start growing again from Q2 onwards.
Driven by
The peak selling season hitting, and crucially, that expected improvement in profitability. Their goal, they said, is to end 2025 with a higher cash balance than they had at the end of 2024.
So the whole Q2 and beyond story really hangs on delivering that continued strong volume, getting margins solid, and actually hitting that profitability target.
That's definitely the core message from the guidance. They pointed to things like continued product portfolio refinement, adding even more stores, another 300 to 400 planned for Q2 in China, and realizing the benefits of their cost controls and that overseas supply chain shift.
Okay, let's try and pull all this together. We've gone through the numbers, the strategies, the guidance. What does this all mean if you're someone following Nihor or maybe just the electric mobility sector in general?
Well, I think it paints a picture of a company that's really pushing hard on two fronts simultaneously. On one side, you have this aggressive drive for volume growth, especially in China, using new products and massive channel expansion, both online and offline.
The 66% growth engine.
Right. And on the other side, you have this intense focus on improving profitability. That involves cost cutting at home, but also making these strategic bets overseas, like doubling down on the higher margin electric two-wheelers via direct sales, while also trying to fix the issues in micromobility with price adjustments and moving manufacturing.
So it's about managing the current headaches while really stepping on the gas for growth.
Pretty much. The call framed Q1's loss and cash outflow as, partly seasonal, partly due to temporary issues like clearing that European inventory and navigating the U.S. tariffs. The whole guidance narrative is built around the idea that those things ease up and their strategic fixes start working, leading to that big jump in Q2 revenue and the return to profit.
So for someone listening, it's about weighing those challenges they acknowledged against the recovery plan and growth drivers they laid out.
Exactly. You have to look at the Q1 issues, but also evaluate how credible their specific plans for Q2 and the rest of the year sound.
Okay, now let's shift gears for our segment called This Is Not Financial Advice. Just a reminder, anything we talk about here is purely a thought exercise. It's based only on the public information from the earnings call we just discussed. Please, absolutely do not base any investment decisions on this part.
Yes, that disclaimer is crucial, crystal clear, not advice. But sticking only to what management said on the call, here's an outrageous but plausible idea to chew on.
Lay it on us. Outrageous but plausible.
Okay, remember how management specifically guided for 3 to 5 times sales growth for their overseas electric two-wheeler segment for the full year 2025?
Yeah, the mopeds and motorcycles, 3-5x growth expected.
And they stressed that the direct distribution model for this segment yields higher margins. And crucially, they already saw a 3x volume increase in just that segment in Q1.
Okay, got those pieces. What's the outrageous idea?
The idea is, what if the market is currently too focused on the Q1 net loss headline, or maybe the temporary struggles in the lower margin micromobility segment? What if it's significantly underestimating the potential impact on the bottom line from this specific overseas two-wheeler segment, achieving that guided 3x to 5x volume growth, especially since it's stated to be higher margin?
So the market might be missing the profitable growth story hiding within the overseas numbers.
Potentially. The thought exercise is, could you make an outrageous but plausible bet that as the results for Q2 and the second half come in, confirming hopefully both that exponential high margin growth and the overall company return to net profit they guided for, that the market might then significantly re-rate the company, basically paying more attention to that future profit stream once the Q1 noise fades?
A hypothetical bet that the market catches up later to the potential of this specific high-growth, high-margin segment they highlighted. Purely hypothetical, based only on the call.
Exactly. Not advice. Just connecting the dots from their specific guidance. Asking if this happens, as they say, what could it mean for the valuation perception later?
Got it. That brings us to the end of our deep dive into the Niu Technologies Q1 2025 earnings call.
So we covered the strong Q1 volume and revenue, mainly powered by China's momentum, the product and channel strategies there, the contrasting overseas picture, high potential in two-wheelers, versus the micromobility challenges, the detailed financials showing margin pressures but improving efficiency, and that crucial guidance pointing toward a Q2 profit turnaround and strong full-year growth.
Yeah, the main takeaway seems to be management presenting a story of navigating these Q1 headwinds with specific strategies, product, cost, channels, supply chain shifts, all aimed at leveraging their position for growth and getting back to profitability very soon, starting next quarter, according to their forecast.
And one last time, just to be absolutely clear, our discussion today was purely informational, based on the company's public statements in their earnings call. It is not in any way financial advice.
Right. And to leave you with one final thought stemming from the call, management talked quite a bit about expanding that overseas electric two-wheeler line, pushing into higher performance, even off-road models. Thinking longer term, how might that deliberate move beyond just basic urban transport start to reshape Niu's brand identity and maybe its competitive position in the wider, rapidly changing world of electric mobility? Something to ponder.